Imagine building a professional-grade, long-term market prediction without ever having to look at a single price chart. To follow along with this process, you only need 3 things: a financial data website, a seasonal tendency calendar, and a free demo trading account. There is one golden rule to this methodology: time always comes first, and then price. It is incredibly common for beginners to fall into the trap of staring directly at candlesticks, trying to guess the next move before establishing any underlying context. Forcing yourself to start with a strict fundamentals-first approach is the only reliable way to filter out daily market noise and isolate high-probability trends before they even happen. Step 1 of your monthly analysis begins before you open any trading software. You start by simply checking the current calendar date. You use that date to check for seasonal tendencies. These are specific times of the year when markets historically repeat their behaviors. Let's apply this to a specific asset, like the Australian dollar. This chart maps the Australian dollar's yearly seasonal cycle. A low typically forms in January, followed by a strong rally from March through May. Another low forms around June or July, before dropping into sustained weakness from August through October. So if our calendar tells us we are stepping into the month of June, our historical data suggests the Australian dollar is due to form a low and begin rallying. Keep in mind, seasonal data provides a statistical edge. You never use a calendar alone to blindly force a live trade. To act on that expected June rally, we have to find a real-world economic reason that justifies why the price should move up. This brings us to interest rate differentials. Central bank interest rates are the single strongest driver across all global asset classes. Our goal is straightforward. We want to find a country offering a high interest rate and pair it against a country with a low interest rate. First, we look up the Reserve Bank of Australia. A quick search shows their current interest rate sits at 1.5%. Next, we cross-reference that yield by looking up the U.S. Federal Reserve, where we see a lower rate hovering around 1 to 1.25. Combining the June seasonal tendency with the Australian yield advantage gives us a definitive macro bias favoring a long position on the AUD-USD currency pair. You have just engineered a highly informed, long-term directional bias, completely independent of any technical indicators. Completing this exact workflow at the end of every month provides an unshakable roadmap. It keeps you anchored to the actual drivers of the market, preventing you from getting lost in lower timeframe volatility. Now it is time for you to do the work. I want you to execute this exact same workflow on your own favorite currency pairs. But there is a strict, non-negotiable rule. These newly formed biases must only be tested inside a simulated demo account. Mistakes are inevitable when you are learning this. Risking live capital without proper practice will result in severe financial damage. Embrace your losses inside the demo environment. Treat those mistakes as premium insights that show you where to improve, rather than seeing them as failures. Make sure you subscribe to the channel so you do not miss the next phase of this mentorship. In Module 2, we will take this newly built macro bias and finally translate it onto our monthly candlestick charts. Putting in the foundational work today is the only guaranteed path to sustainable trading success tomorrow. Good luck and good trading.